Welcome to Investment 360, your wrap of the top funds and investment insights in South Africa and beyond. I'm Bronwyn Nielsen. Now, coming up on the show, we chat to Paul Duncan, investment manager at Catalyst, and Graham Bell, strategist at Old Mutual Equities. Remember to follow us on hashtag investment_360. Welcome back to Investment 360. Now, the SA listed property index recorded a negative total return of 3.47% for August this year. The question now is, should investors take advantage of the hiccup in the South African listed property index and increase their exposure to this asset class? Paul Duncan, investment manager from Catalyst, is here to talk to us about investing in the listed property sector. So should we be taking advantage of the downward pressure that listed property has experienced of late, Paul?
I think clearly if you have a long-term view, the entry point now is significantly more attractive than it was a couple of months ago. However, there still is clearly some downside risk in the short term. I think there's a lot of uncertainty with regards to capital markets and decisions coming out of the Fed out of the next few days. And I think were yields, global and local bond yields, to move out, we'll have some short-term weakness in property share prices. But if you truly are a long-term investor, I think the entry point is attractive, and I think a total return expectation of 12 to 14% of this level is a reasonable expectation on a 5-year view.
What are the biggest risks that we face in this asset class at the moment?
Look, I think from a pricing point of view, clearly, capital market volatility that I spoke of earlier is going to have an impact on share prices, and that clearly makes people nervous. If your views are around short-term rates and even longer-term rates drifting out and that not being fully priced in, you'll see some short-term price weakness. However, over the long term, one of the most endearing aspects of the asset class is that you have inflationary type income growth, and the longer you hold the investment, the more likely that is to offset bond yields moving out in the short term. On the ground, the fundamentals in South Africa remain challenging, so that remains a risk. We clearly aren't out of, we're still in a troughing period in terms of where property fundamentals are. The other aspect that clearly is a risk to my mind is funding costs for a lot of these property companies. Where the rates at which they borrowed to acquire assets over the last 2-3 years, clearly those rates are drifting out and are going to impact earnings growth negatively.
Paul, where do you allocate your money within the listed property space? Do you go for the bigger stocks that we understand that have been dominant, or do you go for perhaps some of the newly listed vehicles or newly listed companies?
Look, I think when the market is volatile, like it has been over the last little while, the large caps tend to move more vigorously because of their liquidity. So non-property players tend to use the large caps like Growthpoint and Redefine and Capital as proxies for investing in listed real estate and interest rate sensitive property companies. So they tend to either underperform when the market is selling off and outperform when the market is very strong. So more recently they have underperformed and are starting to show some value. Whereas obviously holding some of the less liquid mid-cap stocks purely because of their illiquidity actually tended to hold up a little bit better. So, were your view to be that there's a recovery of this phase, I'd probably be looking at the blue chip large caps because some value has crept back into those companies again.
Taking into account the smaller players and their relative illiquidity, as you referred to, when you compare that play versus the buying of physical property, how do you stand on the comparison there?
Look, I think first off, what we have to differentiate is when you're buying a property company or shares on the exchange, you're buying the equity in a property company. You don't actually own the direct real estate. So you stand behind other providers of finance, you stand behind bank debt. So you demand a higher required rate of return necessarily than owning the direct real estate. However, against that you have liquidity, which you don't have in owning direct real estate. You can buy a direct property, you lower the volatility of the return profile of the underlying asset profile, but you don't have the liquidity that you have in the direct sector. So they tend to trade each other off quite a lot. But the big differentiating factor is obviously the sectoral exposure of the company that you're acquiring, one versus the other and versus a direct property investment. For example, the most dominant and most resilient real estate asset class through time are regional shopping malls because of their ability to capture consumption growth and inflation growth over time. However, the ability for the man on the street to get access to a canal walk in his personal capacity, it's physically impossible, but he can gain exposure to that type of real estate by owning high prop shares, for example.
So do you like that strategy, Paul, where you go for the listed property stocks that have high exposure to the retail environment?
Look, for us, being a bottom-up manager, the price is all important. So clearly, retail stocks have a more resilient cash flow, earnings growth profile. But if that is already in the price and it's looking expensive for the growth outlook that we foresee, or the return expectation is lower than the return that we demand for that particular investment, we would not hold it. Similarly, if the office sector is looking weak, but the share price reflects that weakness and there's some additional return expectation in excess of the return we demand for that higher risk subsector, we will own that stock. So it's all relative on price, obviously. But through time, clearly we believe retail and dominant regional retail will have a more resilient earnings growth profile than offices, which are a lot more cyclical, and industrial, which are a lot more cyclical.
Well, you mentioned the office space, and another debate raging is A grade versus B grade, where A grade seems to be way outperforming anything in the B grade space. Is that still the trend?
Yeah, I think clearly what you've got to remember is that in portfolios, rentals escalate based on the underlying lease contract. So what we're seeing in the direct market today is that market rental growth is flat. So existing B grade office users, their rental lease agreements are escalating by 8% per annum. So the actual rent they're paying is kind of moving closer to where A grade rents are. So they're tending to actually trade up. They're paying when their leases are expiring into A grade space because the rents that they were paying have grown to where A grade rents are. So people are typically moving out of B grade and into A grade because it's becoming affordable, because A grade rents aren't growing. The one caution I have with offices, though, is that we are starting to see a lot of supply come to market most recently. You just have to look at what's going on in Sandton, in the Cape Town CBD, the new estate coming on in Waterfall. My concern is obviously that there doesn't appear to be enough demand to satisfy some of the supply that is coming, and that is likely to place a cap on office market rental growth in the medium term.
Paul, I don't want you to share competitive information with us, but if you could share with us your top 4 plays in the listed property space and the rationale for that play, that would be most interesting.
I think clearly, obviously, pricing dependent, but stocks that we like currently and through time because of their ability to capture earnings growth on a sustainable basis are companies like Hyprop, own Canal Walk, the Glen, currently doing a refurbishment to effectively consolidate Rosebank Mall, Hyde Park. Like Hyprop on a long-term view. It may look expensive on initial yield, but the ability to grow earnings in excess of their peers, we believe, is entrenched. Other stocks that we like in the large cap space currently are Capital. They have a opportunity in terms of a development pipeline through the old Clarewood Racecourse and some industrial development opportunities, which I think which will stand them in good stead over the coming years, and they have a very conservative balance sheet. I commented on interest costs being a concern for a lot of property companies going forward. They've hedged a lot of that risk. In the small cap space, I think because the small or mid caps have held up through the recent pullback, they're probably not looking as attractive as they were 3-4 months ago on a relative basis. But stocks we still like are the A units. In particular, we think Ascension A is mispriced, where you get an attractive initial yield with preferred growth in distributions. For that attractive initial yield, you get very little liquidity. It's a very thinly traded stock, so investors need to be cognizant and comfortable with that. And then in the sharpshooter sort of small cap space, I would say that companies that are well positioned right now with strength on their balance sheet are companies like Investec Property Fund and also possibly the Ascension B units, which I believe are doing some clever asset management deals that will drive good growth to the B units over the next 2 to 3 years.
Paul, thanks so much for your time. Paul Duncan, Investment Manager at Catalyst. After the break, we chat to Graham Bell, Strategist at Old Mutual Equities.